Imagine waking up to find that a single company quietly owns almost 3% of all the Bitcoin in existence. Sounds wild, right? Here's the kicker. This isn't a theory. It's happening as we speak, and it could shake the entire financial landscape. Michael Saylor's company, Strategy, has spent 5 years relentlessly snapping up Bitcoin, amassing nearly 3% of the world's supply, putting billions on the line, and potentially tipping the scales of the entire crypto market. Consider this, out of Bitcoin's hard cap of 21 million coins, Strategy controls 628,946. That haul is now valued at about $76 billion. To celebrate their 5-year buying spree, they just grabbed another 155 Bitcoins for a cool $18 million, proving they're not slowing down. Sure, on paper, this daring move has paid off, pushing Strategy to the front lines of the crypto world. But here's the catch. Could one firm wielding so much power in a decentralized network spell disaster or spark the next historic price surge? If Strategy's massive gamble fails or wildly succeeds, the fallout could ripple through every investor's wallet and even threaten Bitcoin's very foundation. The stakes? They're nothing short of your financial future, no matter where you stand on crypto. So how did Strategy pull off this epic accumulation? And what does it actually mean for the rest of us? Let's break down how they built this empire step by step. 5 years ago, Michael Saylor did something almost no other CEO dared. He put his company's entire savings into Bitcoin. But who exactly is Michael Saylor? He's the founder and executive chairman of Strategy, formerly known as MicroStrategy, a business software company that, until recently, was rarely in the headlines. That changed in August, 5 years ago, when Saylor announced that Strategy would make Bitcoin its new treasury reserve asset. The move was radical, trading traditional cash and bonds for a digital currency many still saw as a gamble. At first, critics called it reckless, but Saylor had a vision. He believed inflation would erode the value of cash, while Bitcoin's fixed supply, capped at 21 million coins, made it the best possible store of value. Over the next half-decade, Saylor led Strategy through a relentless campaign of Bitcoin accumulation, making regular and sometimes massive purchases regardless of price or market sentiment. Just this week, to mark the 5-year anniversary of its Bitcoin pivot, Strategy added another 155 Bitcoin, spending around $18 million at an average price above $116,000 per coin. This brings the company's total holdings to an astonishing 628,946 Bitcoin. That's worth nearly $76 billion and represents almost 3% of the entire Bitcoin supply. In the words of TradingView News, this makes Strategy the world's largest public holder of Bitcoin. And as Finance Yahoo reports, Saylor's aggressive treasury strategy has delivered outsized gains and reshaped corporate Bitcoin adoption. The numbers are staggering, but so are the risks. By betting so heavily on Bitcoin, Saylor has transformed his company from an obscure software player into a proxy for the entire crypto market. If Bitcoin rises, Strategy's value soars. If it crashes, the impact could be catastrophic, not just for Saylor, but for every shareholder and employee whose fortunes are now tied to the world's most volatile asset. Understanding these early decisions is key. Ignore the risks, and you might be setting yourself up for disaster. With every new purchase, Strategy cements its influence over Bitcoin's market structure, stirring debate about whether this is bold leadership or a dangerous gamble with consequences that reach far beyond one company's balance sheet. But what happens when a public company keeps buying, even as prices skyrocket and critics warn of growing risks? The endgame might surprise you. To understand the real stakes, we have to dig deeper into how Strategy's Bitcoin playbook evolved and what it means for the future of both the company and the crypto market. Imagine waking up to find that a single company controls nearly 3% of all Bitcoin, a move that could make or break fortunes worldwide. Miss this, and you might be blindsided by a financial shift that could either skyrocket your investments or wipe them out without warning. Now, let's break down how we got here. Michael Saylor's company, Strategy, has just crossed the 5-year mark in its unrelenting quest to accumulate Bitcoin. Their most recent purchase, 155 coins for $18 million, pushing their total stash to just under 629,000, almost 3% of Bitcoin's entire supply, a concentration public markets have never seen before. At first glance, this seems like a genius power play. Strategy's bold approach has delivered a 100% annual return since inception, while its stock price has soared 31% this year. Saylor's core belief is straightforward. Treat Bitcoin like digital gold, and the biggest holders will inevitably win. But this high-stakes gamble cuts both ways. When a single player amasses so much, the very decentralization Bitcoin was built on starts to crack. If Strategy ever needs to unload even a small portion, it could flood the market, potentially triggering a wave of panic selling and wiping out billions in value. This isn't just a risk for shareholders, it's a systemic threat for everyone with skin in the crypto game. Strategy's financial moves now echo through the entire crypto ecosystem. A sudden policy change, disappointing earnings, or regulatory pressure could force a massive sell-off. The fallout? A collapse in confidence, not just in Bitcoin's price, but in its foundational promise of neutrality. Yet, if Saylor's strategy keeps working, he could redefine how companies manage their treasuries. Other CEOs might feel compelled to jump in, accelerating institutional concentration and possibly giving rise to a new class of digital monopolists. Is this the future Bitcoin deserves, or the very problem it was built to solve? There's no denying the upside. If Strategy's bet pays off, it could drive Bitcoin and its own shares to record highs. But the risks are equally real. One wrong move could unleash chaos, eroding trust and stability across the entire system. So the stakes are clear. Can this kind of corporate dominance last? Or are we heading for a meltdown that could reshape not just Bitcoin, but the foundation of digital finance itself? But what exactly pushed Saylor and Strategy to double down on such a risky approach? To understand, we need to look at the origins of their bold Bitcoin play. Imagine a world where corporate giants, not individual investors, set the pace for Bitcoin's future. That world is no longer hypothetical. Michael Saylor's company, Strategy, has just cemented its position as the world's largest public holder of Bitcoin. Over 5 years, they've amassed nearly 629,000 Bitcoin, close to 3% of the entire fixed supply. Their most recent purchase, 155 Bitcoin for $18 million, marks a 5-month low in buying, yet their dominance remains unshaken. This relentless accumulation strategy has delivered eye-popping returns, reportedly doubling every dollar invested each year since inception. Saylor's playbook has inspired a new breed of corporate treasurers, each eyeing the same outsized gains that have reshaped how companies think about reserve assets. As Yahoo Finance put it, Strategy's aggressive treasury strategy delivers outsized gains and reshapes corporate Bitcoin adoption. But what happens if other companies follow suit? The landscape could shift dramatically. If Apple, Google, or other tech titans decide to match or surpass Strategy's holdings, the game changes overnight. An arms race for Bitcoin could erupt among S&P 500 firms, driving the price to previously unimaginable heights, but also concentrating power in fewer hands. This kind of corporate land grab carries profound risks. Bitcoin was built with the promise of decentralization, yet a world where just a handful of companies control a significant chunk of the supply risks trapping Bitcoin in new power structures, the very thing it was meant to fight against. If even one of these giants stumbles, it could trigger cascading effects. Imagine if Saylor, after years of unwavering conviction, decided to sell. The shockwaves would ripple through every exchange and portfolio, potentially wiping out smaller investors and shaking faith in Bitcoin's narrative as unassailable digital gold. And what about Bitcoin's story itself? Once championed as the people's money, resistant to manipulation by any single entity, its narrative could be rewritten. Bitcoin might be seen less as a decentralized asset and more as a corporate reserve, vulnerable to boardroom decisions and quarterly earnings calls. The very ethos of Bitcoin could be at stake. The future is unwritten. Corporate adoption could propel Bitcoin to mainstream acceptance, unlocking trillions in market value. Or unchecked accumulation might undermine its credibility, inviting regulation or even mass sell-offs if confidence cracks. Either scenario will reshape not only Bitcoin, but global finance as we know it. But before you rush to mirror Saylor's strategy or write Bitcoin off as captured, there are some crucial lessons lurking in his approach that every investor needs to understand. Let's examine what Saylor's bold moves reveal about risk, conviction, and the strategies that might actually work for everyday investors. Should you copy Saylor's audacity or hedge against it? That's the billion-dollar question every investor and business leader faces right now. On one hand, Strategy's bold Bitcoin play has delivered jaw-dropping results. Over 5 years, Michael Saylor's company has amassed more than 628,000 Bitcoin, nearly 3% of the world's supply. Reports say this approach has produced annual returns averaging 100% since inception. Even this year, Strategy's stock is up 31% as they added another modest batch of 155 Bitcoin for $18 million. But extraordinary returns come with extraordinary risk. If you mirror Saylor's conviction and Bitcoin soars, your portfolio could enjoy similar outsized gains. But if things turn, the same aggressive approach could magnify your losses. Remember, Strategy is now so large in the Bitcoin ecosystem that its moves alone can impact the broader market, raising both opportunity and systemic risk. For individual investors, this means asking hard questions. Are you comfortable with this level of concentration? Do you have the discipline and the stomach to hold through wild volatility, just like Strategy? Or would it be wiser to diversify, taking some inspiration from Saylor's strategy, but keeping your risk in check? For businesses, it is about more than just copying a headline strategy. Consider your treasury needs, your industry regulations, and your stakeholders' tolerance for risk. Saylor's relentless buying has paid off, but it is not a blueprint. It is an audacious bet that could still unravel if the tides turn. What you do next could define your financial future. Emulating Saylor could set you up for the next bull run, or drag you down if the market crashes. The key is knowing exactly how much risk you are truly willing and able to take. So, with all this in mind, here's the real question. Is Saylor's Bitcoin experiment a blueprint for the future, or a warning sign for the rest of us? Is Bitcoin still decentralized if one company holds the keys? Strategy, led by Michael Saylor, now owns over 628,000 Bitcoin. That is nearly 3% of all coins that will ever exist. In just 5 years, what started as a bold bet has become a staggering concentration of digital wealth, valued at almost $76 billion. Supporters argue that this proves institutional adoption is working. Strategy's annual returns have doubled every year, and the company's stock has soared. But at what cost? When one boardroom can control so much of Bitcoin's fate, is the dream of a decentralized, trustless network fading? The very ethos of crypto was freedom from central powers. Decentralization was meant to put control back in everyone's hands, not just those with deep pockets and global influence. What if Strategy falters? A single company with this much Bitcoin could impact prices, confidence, and even network security. If this experiment goes wrong, the fallout could touch everyone, from smallholders to major institutions. Should Bitcoin's future be shaped in corporate boardrooms or returned to the collective community? The next chapter of crypto depends on what we do now. Let's explore what happens if the balance tips too far and how you can protect your own place in the new financial order.